Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Yes, it's Friday once again, and that means it's time to talk finance with Luke Smith from Envision Financial. Good afternoon.
Good afternoon.
It's a Friday again. It comes around so quickly. My head is spinning. I almost don't know what day of the week it actually is. Nevertheless, we've got a rather important topic to talk about today, and it's one that people often overlook. And how can people use superannuation to fund their insurance needs to protect both themselves and their family? When we think about our super, we obviously think about our retirement funds, but we don't always think about the insurance arrangements that can often be associated with our super funds.
Yeah, look, exactly right. And I think we've had a few instances of late where, this has become quite topical. So I thought I'd sort of put it out there and just get people thinking. And if they do nothing else, but just go and have a look and see what they have. Because your insurance requirements are very much a living, breathing thing to an extent. Now, they're not the sort of thing that you change 2 or 3 times a year, but I find more often than not that people come in, have a look, and haven't reviewed it for a decade. And what you needed a decade ago may be vastly different to what you need now. And when we think about insurance, we have to think about primarily, why do we need it? And what are we trying to achieve? And we come back to that why. Why have we got it? I'm not against people having it. I'm not necessarily for people having it either if they can't give me a clear why and its purpose in achieving a specific outcome. So when we think about how we can insure ourselves, 2 primary ways that we can do it. We own the policy ourselves outside of super, or we own the policy inside of super. Now, not all insurances can be held through super in a general sense. What people would often find when they look in their superannuation and log in to find out they haven't been hacked is that you'll generally have life and TPD insurance through your super fund, and the cost of the insurance is deductible to the fund, which is a positive, because life and TPD insurance outside of super is generally not tax deductible where it's for a capital purchase like paying off debts or funding kids' education. You'll also find through a superannuation fund that you may have income protection. Now, depending on the fund that you're with, you may or may not have cover. Insurance is generally put into most industry funds because it's a little bit like the mineral water when you go for lunch. When someone says, would you like sparkling or flat? And you find out later that the sparkling mineral water was the same price as a bottle of wine. This is generally what happens with industry funds and insurance, which, saves people's bacon in some instances. But it's important that you have a look and understand what's the default amount of cover that I've got. There's a very good chance that your default amount of cover will not be appropriate for your needs. And I recommend that people consider what they'd like to try and achieve and then amend it accordingly.
One of the important things to remember, of course, is that your insurance needs are likely to change over the course of your lifetime. Particularly when people are young, starting out, establishing a family, if they've got a couple of kids maybe, and a nice house with a great big fat mortgage.
Correct.
It's always a really good idea to have enough life insurance to make sure that mortgage could be paid out and a little bit left over as well. In the tragic and unfortunate event that you pass away prematurely. As you get a little bit older, though, you don't always need that much insurance, though.
And that's exactly right. And that's why, I had an instance the other day where a gentleman came in with $1 million in the bank and unbeknownst to him was still paying $1,500 a month for life and TPD cover, which was completely inappropriate. So that got knocked on the head very quickly. And that's why I urge people, have a look, because nobody knows if something tragic is going to happen to you, and it's not something that anybody wants to have to endure. But the devil here is really in the detail, and I'll give you some examples. With most default insurance policies for income protection through super, they may have a 2 or 5 year benefit period. Now, your income is probably the greatest asset that you have because it underpins your existence as you know it, and generally, between a couple or as an individual, funds the needs of a family, children, education, mortgages, and everything else that we have on a day-to-day basis. The default level of income protection through super may be less than 70% of what you're earning. It may have a benefit period of 2 or 5 years in some super funds. And I would argue that anybody under the age of 60, a 5-year benefit is going to be inappropriate because you would like the capacity to have your wages repaid to you in the event of a claim for as long as possible. And income protection policies can be held right through to age 65. Now, you need to have a look in your fund, because if you're 40 years old, you have a massive mortgage and you've got car lease payments and some school fees and a partner that likes stuff, and you take your income out of the household equation, lifestyle, as your family knows it, is going to change significantly. And if you were going to have one type of cover over any other, I would recommend people consider looking at income protection, because at 35 and 40, the value of that policy in the event of a claim, when you look at, say, 40 to 65, if you could not go back to work, generally speaking, the value of that claim would be greater than the life insurance number that you have in the event of your death. You also need to then think about the benefit period. As I said, the best you can get is to age 65. If you have 2 and 5 years in your super fund, approach them and see if they do offer an extension to age 65. So you want to check and say, am I securing 70% of my current earnings? Because the super fund may not have been updated in relation to your remuneration, and they may be working off a figure that they had 5 or 10 years ago. So you can cover 70% of your earnings. You can have a benefit period to age 65. That would be great. If you can't get the longest one, you can. Also remember that you can have a policy inside the super fund paid by super. You then have the ability to take a policy out in your own name where the cost of the premium is tax deductible at your marginal rate. Now, most people, where they have a significant monthly benefit, are paying tax at a rate that is greater than 15%. That is the superannuation tax rate. So if you're paying tax at 34, 39, 47, if you pay tax, you get nothing. If you pay the premium for income protection to secure your wages, you get to claim the cost of that premium against your salary and reduce your taxable income. So think about where you're going to hold your cover. Think about the benefit period that you need in your situation. Next, think about the waiting period. The waiting period is the time that you can go before you're paid a benefit. Generally speaking, shorter the waiting period, more expensive the cover. Longer the waiting period, cheaper the cover. So think about your accumulated leave. Think about your sick leave. Think about money in an offset account. Think about income from other sources, rent from properties, your spouse's wages. Could you go 90 days with no wages? If the answer is yes, then you could look to extend the waiting period and lower the cost of cover. Now, that applies both inside and outside of super. So it's very important that you have a look, get it structured correctly. Again, it's not something that you need to chop and change on an annual basis, but I find most people haven't looked at it for 4 or 5 years. There could also be savings in the open market. So you'd come to somebody like me and say, look, this is what I've got. Is there something else that's available? And you need to consider the benefits and considerations of the policy that you have to ensure that you move to something that's similar. The legislation did change in 2021 in relation to income protection. So for people that have contracts outside of super, be very, very careful about how you move or change your policies, because a number of great inclusions were taken away by the government in 2021 to the detriment of the broader industry as a whole, I believe. When it comes to looking in your super fund, don't think that life and TPD is tax-free coming out. Okay, now we've spoken in the past about super benefits coming out of super to non-dependent kids.
Yes.
This is very, very important. An insurance policy paid to a spouse is paid on a tax-free basis. A lump sum payment from life insurance to non-dependent kids is taxed at 32%. So if you've got a plan to leave the kids $500,000 each, so you've got $1 million sum insured and you have 2 children that are the beneficiaries, 2 things you can do to avoid some real frustration, because if you lost 320,000 of your $1 million, that may limit your kid's ability to achieve what you want to achieve. 2 things you can do: take the policy out of superannuation and hold it personally. A personally owned life insurance policy paid out is not taxed. It is paid to a non-dependent out of super. A tax liability could occur. If you want to fund the premium out of super from a cash flow perspective, gross up for the tax. So you might want to hold 1.4 million of cover, knowing that you could end up with about $1 million after tax to achieve what you want to achieve. So super should be looked at as a funding mechanism, as a holding mechanism for deductions, but it shouldn't be done prior to thinking about the tax outcome and the purpose of the cover.
I was really intrigued to hear you say that of the various different forms of insurance that we're talking about today, you prioritise the income replacement insurance as perhaps the most important one.
Yeah.
And yet I get the impression that's perhaps the one that people think about the least. Everybody recognises the importance of life insurance, and then they think about the total and permanent disability option. I think, oh, that's a good idea too. But when it comes to income protection, a lot of people are very dismissive of that, aren't they?
Yeah, exactly. And I think, like anything, they don't understand the value of the policy because they look at a big number like, oh, here's $1 million life insurance. Well, that's pretty finite. You're here or you're not. You get one go at that.
Yes.
Income protection, in an instance of claim, when you look at what gets claimed first, it generally goes income protection, trauma, TPD, and then life is last. But if you think about somebody that has, a significant benefit of 10 or 15,000 a month, being 75% of a couple of $100,000 of wages, from 40 to 65, you're talking about millions of dollars of lost remuneration. You'd also have benefit indexation on an income protection policy, so it keeps pace with inflation. So it could be worth millions and millions of dollars. And as I said at the start, that could have a much higher capital value and a greater instance of claim, because you can be unable to work because of something that you didn't do. It's not just a case of, I've got sick. You could be in an accident. There could be a range of things that stop you working. That's determined by a medical practitioner. But you could have multiple claims on an income protection policy over your working life. You generally only get to have one go at a life insurance policy. So I think people very much discount, one, the value of income protection, two, the fact that the premium is generally tax deductible to you at your marginal rate, which is wonderful. An income protection definition from an insurance company is better outside of super than it is inside of super for a raft of reasons that would be too long for this show, but be aware of that. If you cannot afford income protection in your own name, super is the next best place over nothing. But I'd stress to people that if you can afford it in your own name, think about it. The one that I find really sort of mystifies people is total permanent disability, or TPD. People need to be really, really careful with this because there are two definitions with TPD and they are vastly, vastly different. So through super, the definition that you have is in any occupation. In the event of a claim, you've been unable to work for 90 days, and two medical practitioners say that it's highly unlikely that you'll be able to do anything that you are suitably trained and qualified to undertake. Now, that is a very, very broad definition. A retail contract outside of super offers you the capacity to say, can I perform my own occupation at the time of claim? Now, I can be a financial planner, and let's say while I was studying, I was packing shelves at Woolworths. If I can't be a financial planner, but I could pack shelves at Woolworths, the insurance company would go, well, there's another occupation that you could do under the any occupation definition. We're not going to pay your claim. So own occupation is the best, most finite definition available in TPD, and I stress that people should look and see what they have. There is a strategy to hold it inside and outside of super because you can no longer hold own occupation definition inside of super, but a lot of people assume, oh, yeah, that's what I have through super. Trauma cover we haven't touched on today is a wonderful form of insurance that pays out in the event of medical diagnoses. Heart attack, stroke, cancer, and about 40 or 50 different medical definitions on a full or partial basis. Now, you can't hold that through super because if you did, the definition of a heart attack does not meet a condition of release under the CIS Act that governs the super world. So even if it was available, they'd pay it to the policy owner being the super fund, and then they'd say, oh, can you get your money out? Well, a heart attack's not a definition to access your super, so you don't hold trauma through super. So we've done other shows on trauma in the past, and it's wonderful cover, but when you're looking in your super fund, you want to look and say, what's my level of cover? What do I need? How can I structure it? Do I need it inside or outside of super? What is my TPD definition? And if you have a skilled occupation, I would stress strongly that you consider own occupation TPD and get some advice, because in the event of a claim, that could be the difference between getting a couple of $1 million and not. In relation to income protection, think about the level of benefit that's through your super fund. Don't assume that the super fund knows how much you're earning or anybody's updated them. If you have default cover, also check, is it fixed or variable? Because as you get older, they will reduce the level of cover by age. That happens in a lot of industry funds and causes a lot of frustration because your debts may not be falling at the same speed depending on how old you are and how long you've been in a particular fund. So make sure that you know how much you're protecting. Make sure you understand your benefit period and waiting period in relation to income protection. And then make sure that you're looking at least 60 to 70% of your wages being reflected in a monthly benefit, which you would see on your statement, and then you would pay a commensurate premium to the level of cover that you maintain.
Luke Smith from Envision Financial is with me in the studio this afternoon. We're talking about how to use your superannuation to fund your insurance needs. We'll be back with more in just a moment. Luke Smith from Envision Financial is with me in the studio this afternoon. Today we're talking about how to use your superannuation to fund your insurance needs to keep you and your family properly protected. And Luke, we've covered a lot of territory today, so what are the key points that people need to think about?
Yeah, so some misconceptions we can sort of alleviate. You don't have to hold your cover through super. You can if you wish. The premium for life TPD and income protection is tax deductible to your fund. But remember that income protection is also generally tax deductible to you at your marginal rate. If you hold life and TPD outside of super, it is generally not deductible. Okay, check and see what amount of default cover you may have in your fund. Consider your needs and some objectives. And when you're coming up with a number, it's as simple as, if I wasn't here, what would I need to clear for my family? That could include a mortgage, that could include the mortgage on investment property, that could include the kids' school fees, that could be giving them a deposit for a house. Whatever your why is, get a number that's appropriate just in case you're not here. In relation to TPD, do not assume that you have own occupation definition in super. You generally won't, and it is not the best definition available. So if you have a specific skilled occupation, I highly recommend that people consider own occupation TPD and consider a super linking strategy where you can have your premiums paid partially by super and partially by you. In relation to income protection, have a look and see what your monthly benefit is. If you multiply it by 12 and then gross it up, it will generally be, or should be, 70% of your gross earnings. That is the most that you can have now under a change in legislation since 2021. Look at the waiting period. That's how long you can go without getting a benefit in the event of a claim. If you've got access to lots of leave, lots of cash, money and offset account, extending the waiting period from 30 days to 90 days, as an example, would save you a lot of money in relation to your benefit. Look at the sums insured. If they were taken out 7 or 8 years ago when you had a much bigger mortgage, as we said at the start of the show, dial it down to what you need now and save some money. In relation to income protection, consider your benefit period. How long are you going to be paid in the event of a claim? 2 and 5 years for anybody under 60 is probably inappropriate. So look and see if you can get a policy with this age 65 benefit period, because that's the most secure way to protect your greatest asset, which is your income. And then just remember that money that is paid out of super in relation to a life insurance policy to non-dependent children will get absolutely belted in relation to tax at 32%. So you've got two options. If it's for non-dependent kids, take it outside of super and pay the premium yourself. The change in the deduction between super and not super would be far less than the tax paid at 32%. So think about that. Or gross up the cover. Have more cover to allow for the tax if you do need to get it funded out of your superannuation fund because you can't afford it in your own name. Have 1.4 million to get around $1 million after tax in the event of a claim for children that are over the age of 18. So if people just have a look, check what they have and structure it correctly, you can make the most of superannuation and ensure you've protected some of your greatest assets.
So Luke, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker podcast on iTunes and Spotify. We've got the YouTube channel Envision Financial Canberra, where we've got a backlog of all of our shows. And all of these types of definitions and strategies are in Smart Money Strategy, your ultimate guide to financial planning. There's an entire section on insurance, the do's, the don'ts, the hows, the whens and the whats.
Fantastic, Luke. Thanks very much. And you'll be back next week, I believe, even though I won't be because it's Good Friday.
That's right. I'll see you in a couple of weeks.
Thanks very much. Luke Smith from Envision Financial on 2CC.